Do you want to earn money while you are doing yoga? There are 5 investments you can invest if you want to get passive income while doing yoga. Disclaimer, this video is about sharing and for education purposes. Again, as usual, investment at your own risk. Hi, my name is Louis, your financial educator. What is passive income? To make it understandable, passive income means money that a one-time investment continually generates without requiring you to monitor or adjust your holdings. The simple example would be, let's say today you use $1 to buy an apple. After you eat it, there are 6 seeds that you can plant. The seeds will grow into apple trees. Then the apple trees will then grow more apples. Then you can sell the apple for money, which is dividend or interest from the first apple fruits that you have invested in the beginning. There are 5 passive income investment tools. First, real estate. Despite fluctuations over the recent years, real estate persists as a preferred choice for investors look for long-term returns. Specifically, rental properties can furnish apartment owners with a regular income stream. The investor can easily acquire a property for 20% down payment, then install reliable tenants who keep the money flowing. Those who don't want to manage rental properties can look to real estate investment trusts, REITs instead. REITs pay out 90% of their taxable income as dividends to investors. On the downside, dividends are taxed as ordinary income, which may be problematic for investors in higher tax brackets. Real estate crowdfunding presents a middle ground solution. Investors have their choice of equity or debt investments in both commercial and residential properties. Unlike REITs, crowdfunding lets investors enjoy the tax advantages of direct ownership, including the depreciation deduction, without the added responsibilities of property ownership. Way number 2, peer-to-peer lending. Although the peer-to-peer lending P2P industry, aka crowdfunding, is just over a decade old, it has grown by leaps and bounds. It is defined as the act of directly lending money to a person or a business entity, where lenders and borrowers are connected via online platforms. Returns typically range between 7% to 12%. And there's very little the investor must do after initially funding the loan. P2P programs generally have fewer barriers to entry than other types of investments. For example, investors can fund loans with investments as small as $100, and investors are allowed to invest through crowdfunding or P2P lending. Each P2P platform has its own set of participation requirements. Number 3, dividend stocks. Dividend stocks are one of the simplest ways for investors to create passive income. As public companies generate profits, a portion of those earnings are siphoned off and funneled back to investors in the form of dividends. Investors can decide to pocket the cash or reinvest the money in additional shares. Dividend yields can vary significantly from one company to the next, and they can also fluctuate from year to year. Investors unsure about which dividend-paying stocks to choose should stick to the ones that fit the dividend aristocrat label, which means the company has at least a 25-year track record of paying out substantial dividends. Here, I would also like to share some tips why companies pay dividends. Companies pay dividends for a variety of reasons. These reasons can have different implications and interpretations for investors. Dividends can be expected by the shareholders as a reward for their trust in the company. The company management may aim to honor this sentiment by delivering a robust track record of dividend payments. Dividend payments reflect positively on a company and help maintain investors' trust. Dividends are also preferred by shareholders because they are treated as tax-free income for shareholders in many countries. Conversely, capital gains realized through the sale of the share whose price has increased is considered taxable income. Traders who look for short-term gains may also prefer getting dividend payments that offer instant tax-free gains. A high-value dividend declaration can indicate that the company is doing well and has generated good profits. but it can also indicate that the company does not have suitable projects to generate better returns in the future. Therefore, it is utilizing its cash to pay shareholders instead of reinvesting it into growth. If a company has a long history of dividend payments, a reduction of the dividend amount or its elimination may signal to investors that the company is in trouble. On the other hand, a reduction in dividend amount or a decision against making any dividend payment may not necessarily translate into bad news about a company. It may be possible that the company's management has better plans for investing the money, given its financials and operations. For example, a company's management may choose to invest in a higher return project that has the potential to magnify returns for shareholders in the long run, as compared to the petty gains that will realize through dividend payments. Number 4. Index funds. Index funds are mutual funds linked to a particular market index. These funds aim to mirror the performance of the underlying index that track and are positively managed. Therefore, their underlying securities don't change unless the composition of the index shifts. For investors, this translates to lower management costs and lower turnover rates, which makes them more tax-efficient vehicles than many other investments. Number 5. Mutual funds, preferably fixed income-based mutual funds. Let's dive into what is mutual fund or unit trust. Unit trust is a pool of funds collected from investors. It is invested by money managers in a variety of securities, such as stocks, bonds, fixed incomes, etc. The term unit trust is often used in the British Commonwealth, while mutual fund is more widely used in the United States. Fixed income funds are funds that are mainly invested in fixed income securities such as corporate or government bonds. Bond is a debt investment which an investor lends money to either company or government. Let's break down the income distribution for fixed income or bond funds. Fixed income or bond funds derive their income for distribution primarily from 3 sources: coupon payments from sovereign bonds or corporate bonds, capital gains from selling bonds that have appreciated in value, and interest income from deposit placements and money market instruments. Generally, fixed income or bond funds pay distributions to unit holders on a fixed schedule, semi-annually or annually. This is because bond issuers, usually government entities and corporations, are obliged to pay interest or coupon payments at fixed interval as well as to repay the principal upon maturity of the bonds. In addition, deposits placed with licensed financial institutions and money market instruments are low-risk investments that provide stable interest income while preserving the nominal capital value. These features make fixed income or bond funds an appropriate choice for unit trust investors seeking to receive stable income. However, it should be noted that capital gains of fixed income or bond funds are subject to interest rate movements. A rise in interest rates generally leads to a fall in bond prices, which could in turn impact the capital gains generated by fixed income or bond funds. Conversely, when interest rates decline, bond prices appreciate and the funds are more able to generate a higher quantum of capital gains. Hence, unit trust investors are advised to stay invested in the medium to long term to ride out the short-term volatility of the bond market, as fixed income or bond funds will be able to provide a steady and regular stream of income through coupon receipts and active portfolio management over time. Passive income investments can greatly simplify an investor's life. The 5 options above represent differing levels of diversification and risk. As with any investment, it's important to weigh the anticipated returns associated with passive income opportunities against potential losses. If you find this video useful, make sure you comment below and hit the like button. If this is the first time you are watching my video, make sure you hit the subscribe button. Every single week we upload 2 videos for you. So hit the subscribe button and go ahead and watch the other videos right now.